I'm talking about note sales and sealed bid sales, and I'm going to start talking about note sales. So what is a note sale? Instead of buying the real estate, the seller or buyer is selling and buying the note and the mortgage securing that note, which encumbers the real estate. So it's buying the loan, it's not buying the real estate itself, but it may ultimately want to get the real estate that way. So from the seller perspective, what are the advantages of buying a note versus buying or selling a note versus selling real estate? So it enables the seller to cut its losses and to move on. Doesn't have to go through the foreclosure process. It's getting paid for the note and it moves on. No more battles with the borrower, no more back and forth. And typically there are relatively few representations in a note sale purchase agreement, and the sale can happen relatively quickly. Big disadvantage, obviously, is the loss of principal, because nobody's going to buy the note for face value. They're going to buy it at a substantial discount. From the buyer's side, the buyer of a note wears two hats. It's both a lender, has to look at the transaction both as a lender and as a real estate investor, because it may very well end up owning the real estate, and that, again, may be the plan. So the due diligence that the buyer's going to do involves both lender concerns and investor concerns. So the lender concerns. The buyer of the note is going to, as a lender, as a future lender, is going to want to know what are the lender's rights and obligations under the loan documents. Are there any obligations to make future advances? Is this a construction loan, or does it have a construction component to it where the buyer of the note may have to advance some more money to the borrower? Obviously, it's going to want to know what are the default provisions in the loan documents. What are the borrower notice and cure rights? What are the lender's remedies in the event of a default? It's obviously going to want to know what is the priority of the loan. Is it a first position mortgage or something else? What are the guarantees? Who are the guarantors? Is it a non-recourse loan, or is there some recourse against the borrower? It's going to want to know what is the current status of the loan. Is the borrower currently in default? Has it been in default in the past? What is the payment history of the borrower under this loan? It's going to want to know the financial condition, obviously, of the borrower and the guarantors, and the condition of the loan documents. Is everything in place? Are all the T's crossed and the I's dotted? And it's going to want to look at the prior correspondence with the borrower so it knows kind of what the history is. And most importantly, it's going to want to have, the buyer's going to want to have a plan. What's it going to do after it acquires the note? Is it going to do a modification of that loan with the borrower? And we'll see that could have some tax consequences. Is it going to do a deed in lieu of foreclosure? Or is it going to go to foreclosure or do a receiver sale, as we've talked about previously? So you got to have a plan. From the investor standpoint, it's like any real estate deal. Obviously, you want to know what the condition of title is. You want to know that there are no environmental issues. You want to know who's managing the property, that they know what they're doing, and that they'll be able to do it properly. And you're going to want to know what is the status of the leases. Is there vacancy? When are terms expiring? What was the rent? What is the credit of the tenant? All the typical real estate investor concerns. You're going to have those concerns when you're buying a note. So you get through the due diligence, you decide you're going to go ahead, you get to the note purchase agreement. Typically there are fewer representations and warranties in a note purchase agreement than there would be in a purchase agreement for real estate. They're probably going to be limited to the status of the loan, that the seller owns the note and the loan documents, has the right to sell them. There's not going to be anything about the condition of the real estate. There may not, the due diligence period is probably not going to be that long. Oftentimes, the due diligence will be done in advance of the actual signing of the purchase agreement. The purchase agreement should identify all the loan documents that are part of the transaction, and it should require the seller to deliver all communication that it's had with the borrower, so the buyer knows what's going on. Yeah?
Is the potential buyer allowed to have direct conversations with the borrower prior to?
I think a lot of lenders are reluctant to do that. I think it kind of depends. I see one or two bankers here in the audience, and I don't know what my experience is. They don't like to do that. I will say that I had a deal where I was representing a owner of a hotel, and we were doing a deed in lieu of foreclosure transaction, and there was an ultimate buyer that was coming in right away to get the property, and at the last stages of the deal, we started having direct conversations with the buyer in the deed in lieu. But I would say normally with a commercial lender, it probably is not something that they want the lender to do. Okay, so the big advantage, obviously, of a note purchase from the buyer's side is they buy the note at a discount, which presumably is going to be a substantial discount from the value or what the buyer sees as the potential value of the real estate. But there are tax consequences. And I need to preface this by saying I'm a real estate lawyer. I am not a tax lawyer. So as I say, I know enough to be dangerous, maybe not even enough to be dangerous. But I did vet these scenarios with my tax partner. So I think it's important to know about this. These don't apply to banks buying the real estate, but they would apply to just a regular investor. So I want to go through these three scenarios. So the first scenario assumes that the note is not publicly traded debt and that the current lender did not buy the note at a discount, so it's the original lender. If the buyer plans to do a modification, which involves a significant modification, I'll talk about what that is, the buyer should be aware that it will have to recognize gain equal to the difference between the original loan amount and the amount the buyer paid for the loan. So, for example, buyer pays $3 million for a loan with a face amount of $5,000. If the buyer then significantly modifies that loan with the lender, it's going to have to recognize gain of $2 million on that when they do that modification. And the reason for that is it's deemed that the old note is replaced for a new note. So that's obviously something, if you're planning on doing a modification, you need to be aware of that. So what's a significant modification? There are 6 tests for that, but essentially, as you'll see, any modification that you're likely to do would be considered a significant modification. If you change the yield, if you change the rate on the note, if you change the timing of payments, you give the borrower an extension of the maturity date, or you say change it to interest only as opposed to principal and interest. If you change the obligor, you add a guarantor, or the security you add, provide for additional security, all of those would be deemed a significant modification. So scenario 2, buyer buys a note and then credit bids at the foreclosure sale. The buyer's going to pay tax on the difference between what the buyer paid and the credit bid. So if the buyer, let's say, bought a $5 million note for $1 million and then goes to foreclosure and credit bids at $3 million, it's going to pay tax on the $2 million gain between the 1 and the 3 that it bid at the sale. And then scenario 3, buyer buys a so-called performing loan with more than 12 months remaining on the term. The buyer must recognize the original issue discount over the balance of the term. So example, buyer buys a $5 million loan for $4 million with 5 years remaining in the term. Any principal payments up to $200,000 per year in that example would be considered interest and taxable and not non-taxable principal, which you would normally expect. And as far as what a performing loan is, all it means is the buyer's paying current at the time, the borrower's paying current at the time the buyer buys the loan. It could have had all kinds of payment problems before, but if it's paying current at the time of the purchase, it's considered a performing loan. So you get through all of that, and then the closing of the note purchase, just a few things that you will need. You want to make sure you get the original promissory note and that you have it endorsed to you, which would either be on the note itself or on an allonge, which is a separate piece of paper that basically says pay to the order of the buyer. You want to make sure that the mortgage and other loan documents are assigned. You want to get notice letters from the seller to the borrower and to the borrower's insurance agent notifying the borrower and the agent of the transfer. And of course, you want to get an endorsement to the lender's title policy, naming the buyer as the new mortgagee on that policy. So that's note sales. I want to then talk about the sealed bid sale. So what is a sealed bid sale? Basically, the seller provides a purchase agreement to all the potential buyers. It includes what the required earnest money is, all the terms of sale, leaves a blank for the purchase price, and the buyers are just asked to fill in the blanks and submit the purchase agreement. So I want to just tell a war story of my first experience with a sealed bid situation. I was we were representing an owner of a downtown office building, and we were negotiating with a prospective purchaser who was planning a major renovation and conversion of this building to residential. And I don't remember the exact numbers, but my recollection is we were talking in the neighborhood of $9 million for this building. And we were somewhat into negotiations. We hadn't signed a purchase agreement, obviously. I don't even remember if, maybe we were in the original stages of negotiating it. And another buyer surfaced that was very interested, I think was coming off at 1031 and needed to invest the proceeds. And we decided to go to a sealed bid situation. I prepared a purchase agreement, said these are the terms, you fill in the dollar amount. And the buyer that was originally going to pay $9 million for the building came in with a bid of $12 million. And I remember opening the purchase agreements, my hands were shaking, and so it was quite a good thing for the seller, obviously, and the other buyer, I think the bid may be in the high tens. So this buyer went from $9 million to $12 million. So what are the advantages of a sealed bid situation? Seller controls the purchase agreement. It sets forth all the terms, just like in the auction situation, but it's the same situation. All the terms are set forth in the agreement. Seller controls the process. It sets forth, again, the terms. As one of my colleagues, I'm quoting you, Bruce, here, all cash, non-contingent. The deal, you can do that with a sealed bid, and you get a quick close with no due diligence, very much like an auction situation. The disadvantage, although it wasn't in the case of the deal that I worked on, but oftentimes there are substantial upfront due diligence costs, which the seller is typically going to have to pick up. You may be able to get the buyer to pay for some of those costs in the purchase agreement, though. So when would you use a sealed bid versus an auction? And Mark, I'm not sure, you may have different thoughts about this, but this was, I talked with a longtime client and who does a lot of this, and so this was his analysis. He said, if there's a small number of prospective buyers, generally you would use a sealed bid, and if there's a perceived wide range of value, you use a sealed bid. So if somehow you perceive that there are a few buyers, two of them think the property's worth $500,000 and one thinks it's worth $1 million, you're better using a sealed bid, because if you went to an auction, the guy that thinks it's worth $1 million may get it for $550,000. Now, I don't know, there's definitely an art to knowing who thinks the property's worth what, but if you do that, it would seem to me that the sealed bid is better. If there's a tighter range of values and lots of potential buyers, then the auction format is probably better. Do you have any thoughts on that, Mark?
Yeah, I mean, I think there's definitely forms and environments to be able to use a sealed bid if it's done, again, properly and properly marketed. I don't think that it forces the buyer to come up with their best number, whereas an auction always forces the buyer to come up with and oftentimes exceed their best number or the number they were willing to pay. From a sealed bid environment, it doesn't there's no incentive for the buyer to really lay it all out there, because in at least many of our experiences, the sealed bid sometimes gets countered. So while you submit the sealed bid, many times you get a callback that says, hey, you're close, do you care to revise your sealed bid? And many times the buyer does. But I think it has its place, and I know people have a comfort level in using it sometimes.
Mm-hmm.
I don't know if Mike, if you have any, Mike's if there's any other perspective on that.
No, I agree with what we were saying. There's but no. There's a time and a place for a sealed bid auction. The problem with sealed bids, in my opinion, is the lack of transparency.
Yeah.
And you're right. In many cases, it doesn't force them to stretch as far as they'll stretch. You got very lucky.
Yeah.
It was skill, I'm sure.
Yeah.
Right?
Yeah.
It's better to be lucky than good.
I've been involved in that the last 7 years, and that doesn't happen a lot.
Yeah.
So you got very lucky.
So sealed means just that, lack of transparency,
Yeah,
for those that
that's
didn't
true.
hear it.
All right. Are there any other questions? Yes.
I wonder if between the combined presenters, if there could be a discussion in the market. Like a lot of what we talked about today is how to handle an unfortunate situation for the seller. But do you see things coming along in the market that says that's really what to talk about right now? What's the market then, or at this point today, what do you see happening in the future?
Well, I can tell you as a real estate lawyer, this is the most active year that I've seen since 2007. I still think it's not back to the good old days, but it's certainly a lot better than I've seen it in a long time. What's your thought on that?
I think there's a lot more activity. I think deals seem to be, this is my personal opinion, I think deals seem to be taking longer still to happen and to close. I think there's a lot of times, whether it's in the traditional market environment or in an auction environment, I think there's a lot of activity going on right now, certainly with all the robust discussions and development going on in downtown Cleveland and the surrounding area. There's a lot to talk about and a lot to be excited about. But one of my colleagues mentioned in a meeting yesterday when we had a company meeting, a lot of those loans that were done in 08, 09 to stay some of the stress or trauma that was occurring on those assets. A lot of those loans are now kind of coming up for discussion. And so at least personally, I've now fielded a lot of new calls on, hey, will you go take a look at this, because we may have a need for a receiver, we may need to look at a program to get this off of our books, or we may need you to talk to the borrower to get it sold because we want out. So that's been my experience, at least. So it's been very unusual, both ways, very positive, but also some fresh discussion on distress.
Yeah, I think the market's somewhat fragmented from my perspective. You see some of the new and exciting developments are going on, but then you see some of the older properties that are distressed. I mean, I can name off the top of my head several older properties that are in receiverships in Northeast Ohio that aren't riding this wave of resurgence that we see downtown and elsewhere.
Are you seeing value, in your opinion, are you seeing values going up, or are you just seeing a lot of transactional activity increase?
I think, again, it kind of depends. I think in the top of the market, there's a lot of value. In some of these distressed properties, and again, I'm a litigator, so I see the distress more than the good stuff, but.
You're still here.
Yes, and so I think where you have older properties that aren't candidates for these conversions to residential, or older shopping centers, that there is distress out there. And think of all the retail and shopping centers that are in receivership. Severance, University Square. I mean, those properties aren't, Chapel Hill, those aren't riding the wave of being in the best time since 2007 that some of these other projects are, like down in the flats and all the things, Nucleus and all the things you see going on downtown.
When an investor, let's say, goes into either a note sale or a sealed bid versus the auction, and they do a modification, and let's say that perhaps the original loan had some tax advantages because you had some tax abatements, will those still continue if a modification is done to the original note?
Well, the tax abatement would go to the owner of the real estate. So, I can't, so I don't think, it wouldn't affect the modification itself, I don't think would have any effect on the tax abatement. Are you talking about if there was a modification and then the note buyer ultimately owned the real estate?
Correct.
I think that would depend on what the terms of the tax abatement were, and so. Yes?
Thinking about buy-sell activity, what impact is the GOP convention having on the market? Is it strictly local, is it spread out, is it nothing?
Just as an observer, I personally think there are an awful lot of hotels being built, and I don't know, maybe they'll be very full for the convention, but I'm a little concerned about what's going to happen after the convention. I don't know how much of that is driven by the convention, but anybody have any thoughts on that?
We just heard a presentation from John Penny, who's at Corman Jackson, I think, who's on the RNC committee. And I think there's a lot, it's an unbelievable economic impact, for sure. We've also spoken with our residential partners in Howard Hanna, who has the exclusive contract to rent, for whatever that means, the exclusive representation for temporary housing for the RNC. And so far, that they haven't quite seen the houses get rented yet that everybody's talking about. But I think the perception is that will change when the candidate pool gets narrowed to maybe 4 or so. So from the residential standpoint, we'll see it. From the hotels, that goes without saying. Every hotel room between here and 30 miles from here will be booked solid. There's a lot of office rentals that are for short term, taking space downtown. Bill, you probably know more about that than I do, about some of the groups that are starting to make their wave into town, and maybe there's others that know a lot more than I do about that, but that's what we're hearing from the marketplace.
Anything else? Well, thank you very much for attending.
Thank you.
Thank you, everybody.